The outlet mall operator Tanger reported record leasing volume last night and increased its guidance for the year. This even as the consumer comes under pressure from rising gas prices and economic uncertainty. Tanger stock was down 2% today, but is still up nearly 9% this year. CEO Stephen Yalof joins us on set here for more on the quarter and the state of the consumer. Stephen, great to have you with us.
Thanks for having me back.
We were just chatting during the break. It's surprising to you. Is it surprising to you that the consumer is still doing well in spite of all of this?
Well, yeah, what we're seeing is a much younger consumer show up in our shopping centers. That's part of the surprise. But, with rising gas prices, the old narrative, particularly in outlet centers, was people had to pile into the car and drive 20, 30, 40 miles to get to the center. But I'm finding that a lot of people are moving closer and closer into the geographies where we have shopping centers. So a lot of the localization work that we've done, restaurants, entertainment, things like that, I think are really resonating across our portfolio, and we're seeing the customer come and shop.
AAA reported that the average price of gasoline is now at $4.30, which is up from, I think, $4.03 or something like that last week. So the spike is real in terms of how quickly it's gone up. At what point do you start getting concerned, this level? I would expect to see some traffic slow down.
Yeah, I think in our outlet portfolio, and, we have some full-price shopping centers, too, and they serve a very localized customer base. So I don't think there'll be as much impact across that portfolio. But in the outlet portfolio, when you're selling value every day, when you've got the opportunity for customers to come in and buy their favorite brands, and, Gap's back, unbelievable business. Nike, Coach, Michael Kors at the best possible price. I think that the customer is like, the gas price is less of an issue when they know they're going to get great savings when they come and they shop.
Stephen, sharp-dressed man. Always love having you. Great numbers last night. Part of that beat was lease income, and give us some sense of also just a step removed from the consumer, but leasing demand and what you're seeing, because on some level, those are the folks, as we just said. I mean, Gap, great turnaround. Not everyone's going through that. So what are you seeing?
First of all, from a tenant point of view, the first thing we say is it's really not about categories, it's about brands themselves. And the brands that are really resonating. So, you'll have the accessory category as an example. Well, Coach is just such an outlier doing unbelievable business. The family apparel category is doing extraordinarily well right now. Gap is an outlier. And, the athleisure business, and we know what's happening with some of the athleisure brands that had, great success in the last few years. But now all of a sudden, the brands like Aerie. And if you take a look at those three brands that I'm calling out, it's that young consumer is really feeding into a lot of that. As far as leasing volume is concerned, there's not a lot of new supply being added to the marketplace from a development point of view. So the M&A business, there's a lot of acquisitions going on. Yeah. A lot of properties are changing hands, but they typically come well leased. So there's not a lot of space, and I find the brands are really competing for space and trading up a lot of these shopping centers. The successful centers are just getting even more successful, and the middle of the pack centers are starting to see interest from brands that they hadn't seen before. And we're really benefiting from a lot of that. Last time I was on, we talked about Sephora, just as an example. Well, Sephora is not an outlet player, but coming into the outlet business because they see a customer shopping with us, and they want to put their product in front of that customer.
So when you say you're seeing strength in the younger consumer in their 20s, and yet we hear stories about, fears of AI disrupting the job market for someone in their early 20s. No. You're not seeing that at all, it sounds like.
Well,
they're working and have money to spend.
Yeah, it hasn't really resonated yet. And we're seeing that Gen Z consumer. That's really a big cohort of ours now. That's who we're marketing to. That's we have a loyalty program. That's who the key players are as we keep on building that loyalty group up. We're seeing a lot more of that Gen Z age bracket coming into our centers and, sort of looking for deals, looking for great brands, looking for the experience, looking for amenities and spending more time. The largest dwell time across our portfolio is coming from that cohort of consumer. Has the AI fear resonated? It's probably more fear than reality right now. So, we'll make hay while the sun is shining, particularly as it relates to that consumer.